your email and check it. You can't get to it, not a big deal. You can see the presentation up there, but the PDF file with the presentation should have come through, as well as the link to the Excel spreadsheet with all of the numbers. Okay? So here's what I'd like you to do. It's going to be really tough to do as I go through today's my version of the analysis of the case. I'd like you to stop thinking, oh shit, I got that wrong, right? Let it go. That's not the point. I mean, I'll tell you up front, most of you, and I've reviewed already, I think there were 34 cases. I've kind of browsed through them. Obviously, I haven't started grading them. I plan to do that right after class today. Most of you got most of the stuff right. Right in the sense of, hey, you were in, you know, there's room for differences on individual inputs. But as I go through, there'll be things we will talk about where you say, oh, maybe we should have done that, right? But let it go. It's got nothing to do with the case, because what I'd like to do is use those things to talk about how it can change the way you do investment analysis, valuation, because as we will see, this project is a microcosm of the kinds of issues you run into when you value companies, value businesses. So let's get started. Okay. I sent that email out at 10:20 because I wanted to give people a chance till 10:29 to turn it in. So there were a couple of cases that came in 10:23, 10:20, but I don't think they have time to go back and review the analysis and change it between 10:20 and 10:25. So nobody's got an advance notice of this, and they couldn't have because I just finished the presentation 15 minutes ago. So in terms of the process, first I want to talk a little bit about something that kind of gets talked about in the case, but which is time. Okay? It's got nothing to do with the case. This is something to do with the way we think about time in finance. In finance, especially when we talk about numbers and valuation, we talk about time as if it's discrete. You know what I mean by discrete time? Everything happens at a point in time. So when we say T is equal to 1, T is equal to 2, T is equal to 3, we're acting as if cash flows come in at the end of every year. Why do we do that? For convenience. It makes our present value calculations a little simpler if things happen at a point in time. But things happen continuously. So if you take Lowe's furniture, they don't sell furniture on December 31st of every year. They sell it through the course of the year. So this is something that we deal with all the time, but I wanted to put it on the table. And that's why I was trying to be as explicit as I could about what does now mean. There is no year zero. There's a point zero. What does now mean? What is year one? What is year two? And in spite of that, there's probably some degree of differences that come through. So with that set up, let me give you my summary of what I found when I looked at the numbers. First, because this is a furniture project, not another building retail store, I used the beta for furniture businesses, and the beta that I got was 1.63. So I'll take you through the mechanics of what I did. So but the key is I used the beta and the cost of capital to reflect the fact that this was a furniture project, not just another store being open. My cost of capital was towards a high end relative to what most of you found. In fact, I'm going to give you a distribution on every single parameter and what the groups found. I was towards the top end. We'll talk about why there might be differences in the cost of capital you arrive at. From an accounting return standpoint, the return I got was about 18 to 22%. Depending on whether I included synergy, did not include synergy, included working capital, did not include working capital. But here again, depending on what you include in invested capital, you could actually come up with numbers more than 50%, depending on how you define invested capital, and lower than 10%. My net present value without counting synergy and side costs was 2.3 billion for the finite life case and 3.964 billion in the longer life case. I'm going to use the word longer life, not perpetual life, because nowhere in the case was it required that you use a perpetuity. I did use a perpetuity, but if you'd used a longer life in the sense of adding 20 years to the project, that would have been perfectly okay as well. Now, one thing I want you to focus on is the difference I am getting between my finite and my longer lives. My difference is 1.5 billion. You're saying, who cares? What does that matter? I'm going to focus on what causes that difference to be bigger. For most of you, that difference was much wider. 4 billion, 5 billion, 6 billion. I'm sorry, is somebody just live? Is there a problem with the Zoom? Okay. Now, if you bring in the side costs, and there are two side issues. One is, remember the stores I take over and convert into furniture stores? I lose sales on those stores from being building. So that's a cost. But there's also a synergy benefit, right? So including those in the process, that reduces my net present value. The costs actually exceed the benefits if you look at the total present value. It creates a minus 537 million net present value and a minus 421 million the longer life. Saying, why is it less in the longer life? Because the synergy continues forever. That kind of reduces it. But the one point I want to make, and it's not a big deal, so don't freak out if this is not something you did. Those are from the building retail business. So the cost of capital I used to discount those cash flows was 7.79%, which is a bit of a pain because it means I have to separate those cash flows from my other cash flows. Because if I incorporate them all in the same cash flows, then it becomes really messy figuring out what discount rate to apply. Based on the numbers, this project looks like a slam dunk. But towards the end of this class, we're going to come back to this question. Is it, I mean, nothing in life is a slam dunk, right? So we'll talk about what are the things we might not have factored in that might still make this project a bad project. So let me start with my costs of capital calculations. I computed 3 different costs of capital. And again, in this case, if you didn't do it, it's not the end of the world. The costs of capital are close enough that you could probably get away using one number. But let me explain the 3 different costs of capital. The first was a cost of capital for this furniture project that reflected its global mix. Remember that you open stores, not just in the US, but in other parts of the world. So here were the inputs. I started with other firms in the furniture business and I gave you the list. So we all had the same list. The median beta that I saw across those companies was 1.59. I think there were 19 companies. I might be miscounting off by 1 or 2. My median debt to equity ratio across those companies was 37%. And the median company had cash of about 7.6% of value. Now remember this, the reason I'm using medians has nothing to do with any financial rationale. It's purely statistical. I'm trying to avoid the outliers from running away with this process. I computed one unlevered beta using the medians. Already you can see reasons we might come up with a difference, right? What's the other thing I could have done? I could have computed the unlevered beta for each company and taken the median unlevered beta. If you do, you come up with a lower number than me, perfectly okay. Because that's, again, nothing to do with finance. It's the statistical reason. I'll give you my explanation for why I take the median numbers and compute one unlevered beta. Anytime you have a number you don't trust, and regression betas, we said, have noise on them. One of the first rules is you don't want to compute operations on a noisy number because it will get even worse. So if my beta is overestimated and I start doing unlevering and cleaning up for cash, the unlevered beta I get at the company level kind of magnifies my mistake at the regression beta level. So I prefer to use the median numbers. And what I get with those median numbers is an unlevered beta in the furniture business of 1.34. If you use the median, if you did the unlevered beta for each company and did the median, I think your number comes out a little lower, 1.2, 1.24. Perfectly, again, completely defensible because just a statistical disagreement about how to do it. So that's my unlevered beta. To get the debt to equity ratio, remember the project did say that Lowe's was going to use its debt to equity ratio from whatever business it's running now as the debt to equity ratio for the project. And there are two components to debt. There's interest-bearing debt and lease commitments. Now, you could just take the accounting lease debt and use that as debt. But that should be overridden by the fact that we looked at lease commitments, it looks immense relative to what the accountants seem to be capitalizing. I don't even know, and this is one of the widest differences I've seen, what the accountants are doing differently. So I took the present value of the lease commitments, and if you remember, I gave you 5 years of lease commitments and a lump sum beyond year 5. You're saying, why don't you break it down? Because that's how they report it. I can't break it down because they don't break it down. I think it's 18,810 million after year 5. And you face a choice. What do I do with that? I just spread it out over 10 years. And you might spread it out over 5, 15, depending on what choices you made. You can come up with a different present value. But I take those lease commitments and discount them back at what rate? The pre-tax cost of debt. Why the pre-tax cost of debt? Because these are pre-tax commitments, and I get a present value of 19.9 billion. Yep.
We did exactly that, and we get 21 billion instead of 90.
Yeah, you broke it down by year, right? I have to check to see why, because I did see that, and I didn't know why, because I checked my present value, and it looks like it's set up right. So, I'll check that because it's around 20 billion when you do the present value. The interest-bearing debt, there was a book value, right? You can look on the balance sheet. And here, there might be mild differences. But what I counted was the short-term borrowing, the short-term portion of long-term debt, the long-term borrowing. I came up with about 24.9, it's about 25 billion book value of debt. And if you look at the interest expenses and the book value of debt and compute the market value, it's actually very close to book value. It's about 25 billion in debt. You add the two numbers together, the total debt you have is about 45 billion. As a percentage of market value, market cap, that's about 29% as a debt to equity ratio and a 22% debt to capital ratio. Again, you can see with mild difference in assumptions, that debt to equity ratio can be as high as 30 or maybe even as low as 24 or 25. None of them is wrong. You're basically making different judgments about what to include in debt. There's really no judgment on it. Yeah, go ahead.
Professor, when you calculated the Lowe's debt to capital ratio, I think there's a mistake in the denominator because you put 41.3.
Oh, yeah. The actual number, it should be 44.7. So basically the ratio is right, but I never fixed the denominator.
Because my numbers are very similar, but like our ratio is different, like debt to capital ratio. So that's why I was kind of confused.
So I think that the 22% is right. The 41.7, the denominator should be 44 point something, whatever it works out to 44.7. So the initial run, I did not include some interest-bearing debts. I went back and included it, and I never fixed the denominator. So it's about 22% debt to cap. So let's now talk about how that plays out in your calculation. First, if you look at the levered beta for Lowe's furniture, I start with the unlevered beta for the furniture business, 1.34, 25% tax rate, 28.57% debt to equity. I come up with a levered beta of 1.63. Because I start with a higher unlevered beta, I end up with a higher levered beta. That higher levered beta then translates into a cost of equity for this project of 10.54%. That equity risk premium, 5.32% here, reflects the mix of stores. As I was browsing through some of your cases, I noticed that when you computed that risk premium, some of you had counted only the new stores in the US, the 40 stores. Don't forget the 50 existing stores that are now going to be converted into furniture stores. Your weights for the US should reflect the 90 stores they will have in total, not just the 40 new stores, because it's a collective revenues from the US. So 5.32% is a weighted average. I did compute a second furniture cost of capital using just the US equity risk premium. And this is nitpicking. So if you didn't do this, don't even think about it twice. You know why I computed just a US cost of capital? Because in the first years, when you're converting existing stores, your stores are going to be almost entirely US stores, or year 2, year 3. Because remember, you're opening these stores gradually over time. So when you think about the year 3, year 4, they're going to be almost entirely US stores. It's only as you get to year 6, year 7, year 8, and you don't know where they open the stores first, that you're probably going to end up with this global mix. In this project, it would have made no difference if I had just gone with that one. But this is something to think about, is when your geographical mix for a project is changing over the life of the project, you can very well end up with this different equity risk premium by year. So the cost of capital of 9.73% is still a furniture cost of capital, but it's just a US furniture cost of capital. There's one more cost of capital I computed, and that's for the building supply business. Oh, actually, let me finish the calculation. If you bring in the cost of debt, you weight it, the cost of capital you end up with is 8.87% for the global mix and 8.15% with just the US. If you go below and look at building retail, I computed cost of capital for building retail. And this is that traditional business. Why do I need this? The spillover effects, the synergy benefits accrue to the building retail. So there's 3 different costs of capital in here. In this particular calculation, they're close enough that you could probably get away being sloppy. Okay. So that's why I'm not going to take off any points for this, because here, who cares that the costs of capital are between 7.8 and 8.5%. But in general, keep that in mind. The discount rate for cash flows should reflect the risk of those cash flows. So I've got a 7.79% building retail cost of capital and 8.15% cost of capital for US furniture stores and an 8.87% cost of capital for the collective cash flows from the project. Any questions? So as I said, at every step in this process, I'm going to show you what the distribution look like for the groups. Yeah. If you have the interest expense and you have the book value of debt, if you take the maturity of the debt, and I gave you a little Bloomberg sheet with the weighted maturity, and some of you said, what the heck are you giving that to me for? It is like 12.22 years. Think of it as a gigantic coupon bond. The interest expenses become the coupon for 12.2 years. The book value becomes the face value of the debt at the end of the 12.2 years, and you take the present value. Here, it made almost no difference. That's why if you use book value, I'm going to say, look, you're close enough. But in general, that is one way to check to see whether the market value of debt is close to. No. It has to be the market current. If you use the average interest rate, you're going to go back to whatever your book value is. The whole point of this exercise, the market interest rate changes, you want to adjust the market value of debt to reflect the fact that it's now going to be less valuable. So if interest rates go from 3 to 5%, your existing debt just became less valuable. It doesn't matter. Everything moves up and down, right? So whatever so when you think about whatever the cost of debt is, anytime it changes, your market value of debt will shift with it. So now so if you look at the distribution, here's what your distribution of cost of capital look like across the projects. I think when I did this analysis, I had to stop at 1010 because I had to have some point in time. So there were 6 projects that came in after 1010. So not counting those 6 projects, I think there were 28 projects. Here's what the cost of capital distribution looked like. The median across the groups, if I could pick a number, was between 8 and 8.25%. There were a few projects with cost of capital below 7.5%. And I'm not sure why. Maybe you were using a building retail cost of capital or some. So it's not that they're wrong, but I want to check to see how, because you can expect differences, but the differences should be within 0.5%. So when you get 2% differences, that's a little, I wouldn't say suspicious, but something that might have gone off tracks somewhere along the way. Okay. There were a couple of projects on the other hand, which had cost of capital that exceeded 10%. So again, that's unusual to get that much of a distribution, but the heart of the distribution is between 8 and 8.25%. Any questions on the cost of capital distributions? Now, the first thing I asked you to do was that useless exercise of computing return on capital. Why did I make you do a useless exercise? Because this is life. You're going to be asked what's the return on capital in the project. At least you need to be able to compute it. And to do this, I need two things. I need after-tax operating income from the project, and I need a measure of invested capital. So my after-tax operating income, I'll come back and show you the full calculation. But if you look at my book value, it's a fairly conventional calculation. Anything I have as CapEx increases that book value. Anything I have as depreciation reduces that book value. And I'm incorporating working capital as part of my invested capital. So if you look at my invested capital, it starts at about 1 billion. And over time, it kind of peaks in the middle and then levels out in my finite life case. The reason I asked you to do the return on capital in the finite life case is you're doing 15 years and the whole process ends. When I look at the return on capital, and clearly, I mean, you can see the pattern starts low and builds up to almost 64%, which I expect all of you found, right? As the project ages, the return on capital climbs. And you're faced with a challenge here. Should I take the average of those 15 years, which is perfectly okay. But remember, if you get really extreme values towards the end, the average is going to get pulled up. And the other alternative, and this is something that I think you might want to consider doing, especially when you have issues like this, is to compute what's called an aggregated return on capital. What does that mean? You add up all your operating income over 15 years. You add up your invested capital. It's like a weighted average. That's a way to think about it. So you can think of the regular average as a simple average. This is a weighted average. I get about an 18% return on capital on the project if I don't count the synergy, and about a 22% return on capital if I do count the synergy. Okay. Yes.
Why in year 0, you're not taking into account the pre-existing stores?
I ignored it because remember the pre-existing stores, I could have brought in their book value, which is one reason some of you have bigger invested capitals than I do. Okay. And I'll tell you why I didn't spend too much time in the return on capital. I wasn't planning to make my decision based on return on capital. So one piece of advice I would give you is if you are caught up in allocation and depreciation decisions, that's where the debate is going. You lost the script, right? Because in a sense, the accountants are driving the script. So that distribution system, you could say, could we allocate 40% to this? And you can make a judgment, and from an accounting basis, makes complete sense. I said, I have bigger fish to fry. I'm going to move on. So that's why when you look at return on capital, this is where the divergence was widest across groups. And it's completely understandable. Because depending on the choices you made about how to compute invested capital, you can get huge returns on capital. I think there are a couple of groups that had more than 50%. And there are a few actually that got very low, single-digit returns on capital because they were allocating everything but the kitchen sink to this project. So on a return on capital basis, the degree that you trust that number, it looks like you're earning more than your cost of capital, which is, remember, between 7, 8, 8.5, depending on how you define. Any questions on return on capital?
Professor, did you put in the excess capacity while calculating the return on invested capital?
What do you, when you do, are you asking me whether I allocated a portion of the investment? Yeah. I didn't even waste my time on it. You could. That's why I said your return on capital will be lower if you allocate that capacity. Because it's a question of how much do you allocate, when do you allocate it, what do you do about the new investment that comes about. But that's within accounting returns, you can see why there's so much room for discretion, especially in the allocation decision.
Thank you.
Now let's talk about the finite life case. And I'm going to draw a clear distinction between the finite life and the longer life case, because you've got to make this decision upfront on the project. Let me explain what I mean. When you start the project, you have to ask yourself, am I going to run this project on the assumption that the project will end at the end of 15 years? Or am I going to run this project on the assumption that this project has a much longer life? You can't wait till the end of the 15th year and say, okay, let me make this finite life project into a perpetual life project. It doesn't work that way. So let's look at the finite life assumptions. And there are a couple of things. One is the existing stores have a depreciation that's feeding through. Okay? That depreciation, I'm going to ignore for my cash flow computations because it's not incremental. You see why it's not incremental? What's the test on incremental? What will happen if I take the project? What will happen if I don't take the project? The depreciation of the existing stores is going to be there anyway. So incorporating it into my cash flows is going to be meaningless. The distribution system is a little tricky. Let's start with the easy part. By taking this project, what am I doing? I'm using up excess capacity on the distribution system. In fact, the question was about that allocation of existing capacity. That's, of course, everybody's, should, I think, made that assumption. So you take this project, you end up with a higher utilization of your distribution capacity. What does it mean? You're going to run out of capacity sooner rather than later. Everybody agree with that? The sooner part, how do you bring in? Well, I think you run out of capacity in year 6 based on my calculations. It could be year 5, depending on slightly different assumptions. I didn't wait until year 6 because remember, time works in discrete points here. So if I wait till the end of year 6, I actually ran out of capacity sometime during the year. Again, that's nitpicking, but I invested at the end of year 5. It cost me $552 million to invest at the end of year 5. That's half of what happens dealt with. I said sooner rather than later, right? So I've dealt with the sooner. But remember, if I hadn't taken this project, I'd have had to invest anyway in year 12. So if you look at just the capacity in existing businesses, if I'm going to invest sooner rather than later, and I'm counting the sooner as a cost, I have to count the savings I'm going to make in year 12. That when you think about incremental effects, you got to think through the whole process. There's savings, there's an offset of not having to spend the money. So I'm going to show a negative cash flow of minus 552 million in year 5, but in year 12, I'm going to show a savings you're going to get from not having to invest. Now, if you really want to be, to be a purist, you can then say, if I invest earlier, I get depreciation earlier. So if you want to play this game through, you have to play through every single effect. Because I'm planning to wrap up this project at the end of 15 years, in my finite life case, I wasn't pumping huge amounts into capital maintenance because that would make no sense. I'm wrapping up the project. Doesn't mean there will be no capital maintenance. So if you made some capital maintenance here because you still need it, that's fine. But it's going to be minimal relative to my longer life case. At the end of the 15th year, I liquidate the project. I get my working capital back. I get the book value, whatever's left of my initial investment back. And you can basically, if you want to even liquidate the distribution system, even though the company is unlikely to do it if they can use it elsewhere. So here's what my numbers look like. When I look at my finite life case. So I think the revenues, we should all be pretty much in agreement. Some of you did include your synergy revenues as part of your basic. You see why I'm not including them here? Because if I include them here, I have to pick a discount rate, and I want to reserve the freedom to use a different discount rate. So you got revenues, you got the direct operating expenses, you got depreciation, you got allocated expenses. And remember, the allocated G&A has 2 parts to it, right? There's G&A that's directly related to the project and the allocated part. And that's every year. And the advertising expenses. You get an operating income, you subtract out taxes at a 25% tax rate. Why? Because this project is at the margin. I'm not going to use the effective tax rate because that'll lower my taxes below where they should be. I get after-tax operating income, add back depreciation. I then reverse the allocated G&A. saying I shouldn't have subtracted it out. But because I also got a tax benefit when I subtracted out, when I reverse it, I reverse it as the after-tax amount. Then you've got CapEx up front. Yeah. I'm sorry, this should be this looks like I'm showing you the infinite, yeah, CapEx. No, that line item, I think reflects the new stores coming through from years 3 through 12. There's an opportunity cost of the distribution system, 552 million. As a cash outflow in year 5, savings of 634 million in year 12. And if you look at the change in working capital, I have an initial working capital. You're saying, why is it showing up in year 2? Why is it showing up in year 2? What did the case say about working capital? There's an investment. I gave you the details. And I slipped in this additional detail, which is the investment has to be made at the start of the year. I said start of year 3. But in terms of time, think of what start of year 3 is. January 1st of that year, December 31st of the previous year. So I'm just moving the working capital back. These are the kinds of things I'm not going to kind of make an issue of when I grade your case, but something to think about is it does make a difference when you have to make an investment. So my working capital needs are basically staggered by a year. And after my first year, it's only the change in working capital. Let me emphasize it again. That initial working capital is done. After that, it's only the change that affects my cash flows. At the end of the 15th year, there's my salvage value. And you're going to get some give on that number, right? Depending on what else you decide to include in invested capital, like distribution systems, you might have a higher salvage value or low one. But here's the one thing that's non-negotiable. Your working capital, you've got to do something with. You can't completely ignore it. Because that's you're throwing out $1 billion into the streets if you do ignore it. That's my incremental cash flow. Now, when you do this, it's a little messy, right? You're starting with accounting earnings, and you're trying to reverse all the stupid things accountants did, like allocation. There's another way I could have actually shown you the incremental cash flow. It's exactly the same answer, but instead of subtracting out that allocated G&A, if I just subtracted out the incremental G&A, the advantage is you now don't have to do that fix. You get exactly the same answer. Something that I think you should think about when you have to do incremental cash flows in a project. If you don't have this need to stop with an accounting earnings in the middle, you can just go directly with incremental items and do an incremental cash flow. It's much cleaner, much easier, much less susceptible to the kinds of mistakes that come about when you're trying to reverse something that's been done in the earnings. Any questions on the incremental cash flows? Yes.
I had a question. So in the first 2 years, the 50 stores that we were closing and revamping, should you, because you mentioned, that Lowe's expected $2 million in after-tax operating income for each store.
Yep.
So why didn't you account for that in the first 2 years?
Okay. Does somebody want to answer it? Because that's true. I've ignored that and the 200 million. The reason I haven't included is these incremental cash flows are going to get discounted, right? At what? At a cost to capital. Remember, I had 3 different costs of capital, one for the furniture business with the global presence, one for the furniture business with the US presence, and one for the building retail business. That $2 million in income that I'm going to lose on those stores, which of those 3 businesses is losing that income?
Oh, it's the traditional business in the US.
Exactly. That's the reason I did it. As I said, if you incorporated them all into cash flows, not a big deal in this project. But it's usually a good idea when you have cash flows coming from different businesses to keep them separate, just to preserve the option of discounting at different rates. Yes. No, you'd get taxed at a taxable income level, right? No company ever gets taxed on operating income. You get to subtract out interest expenses. So all of these taxes are almost hypothetical taxes, right? Because your real taxes are going to, you're saying, why am I ignoring the tax savings I get from interest? Because you're discounting back at a cost of capital. And if you look at the cost of capital, you know how you capture the tax benefits? through the after-tax cost of debt. So almost all taxes computed on these firm cash flows, pre-debt cash flows, are in a sense hypothetical cash flows. Exactly, at the last dollar. So basically think of this as adding to your last dollars of income. And you're saying, what would I have paid in taxes? Yes, back there. Yeah. No, you haven't spent it yet. That's the initial $1 billion that you set up for the investment, right? That's the biggest negative cash flow upfront, because if you decide to go into the business, it does say you got to invest $1 billion. The sunk cost is completely ignored, right? There's like a $500 million or whatever you've already spent. That's irrelevant. It's gone. But this is the new $1 billion that you'll have to invest. I think it's 0.1 or 0.2. It should be the very top bullet point on what the project requires. Yes. I'm sorry, you're not doing it. What do you mean not doing it? You're not doing it because if you invest in year 5, you have capacity now. You don't need the year 12.
No, that's a 2 million.
Oh, no, we're going to do it. We're going to bring it in later. So remember, the fact that I did not include it here doesn't mean it's not going. Of course, it's got to come in. I haven't counted the synergy benefits either, if you notice. That's still hanging out there, but I still will bring them in, but I have to bring them in separately because I need a different discount rate for them. And I do have a discount rate for them. That's why I computed the building retail cost of capital. Now comes the side effects. I was just one slide ahead. Here are my side effects. There are 2 side effects. One is the lost after-tax operating income on the closed stores, the 2 million per store times 50, 100 million for the next 8 years. I think that's, that's what I gave you as remaining life. There are the synergy revenues. Remember that I get $200 million worth of revenues, but you don't get to keep the entire revenues. You get to keep only the operating income and the cash flows. And I said, use whatever operating margin they had in the most recent year. So I think that I took the 2021 numbers, took the operating income divided by revenues. I came up with like 12.5%. You might be off by 1% or 2, depending on how you computed it. 12.56% of my revenues gives me operating income. I pay taxes again at 25%. I get after-tax income. And because there's no depreciation CapEx, that also becomes my cash flow from the side effects of the project. So one negative side effect, one positive side effect. The negative side effects overwhelm the positive side effects. So my cash flows are negative until the stores start to run out, right? The $2 million gets run out. So now I'm ready to pull the numbers together. I've got, in this case, 2 sets of cash flows. The first set of cash flows are the cash flows from the project. So that's coming from my incremental cash flows. My cost of capital, and here's where it's a little tweaky, and you might, if you didn't do this, not a big deal. Initially, I started the 8.15%. If you remember, that's the furniture cost of capital for just US stores. Why? Because initially, it's almost entirely US stores. But I really don't know where the new stores are opening, right? It could all be opening in Asia for all I know. So what I do is I take the 8.15%, the 8.87%, the 2 limits, and I just move my cost of capital from my existing cost of capital to the, it's a trick I play in valuation all the time because it's very difficult to actually get year by year specifics. But if I have 2 numbers, one in year 5 and one in year 10, don't play any games, just move them in linear increments if need be to get from where you are today to that endpoint. You discount back the cost of capital. But one thing, and this is a mechanical thing, and I want you to take a look at what I've done. Rather than use the present value function in Excel, which requires that your cost of capital stay the same, because my cost of capital are changing, I compute a line item called cumulated cost of capital. You're saying, what is that? In year 1, it's 1 plus 8.15%. Year 2, it's at 1.8. So basically, I take the cost of capital each year. I come up with the cost of capital that reflects the rolling cost of capital over time. And what I get as a present value of my cash flows is 2.3 billion. I did compute an IRR just because the numbers are already there, might as well do it. And then I computed the present value of the site costs and benefits using Lowe's building retail cost of capital. That's the whole point of separating the two. So if you didn't separate it, your cash flows would incorporate those cash flows and you'd be discounting back at whatever cost of capital you pick. Not a big deal on this project again, as I emphasized, but something to think about when you have 2 or 3 or 4 different streams of cash flows. So my overall NPV for this project, if I incorporate the side effects, is about $1.8 billion, which actually puts me very close to where you ended up as your median. So this is the distribution of finite NPVs that you gave me. And you can see that, you were around billion, billion and a half, even a little bit over that. So your median cost of capital, I think, was about 1.7 billion. And I was pretty close to that number with my NPV. But notice that there were groups, I think, by the time I looked at the additional groups, I think there were 3 groups which ended up with negative NPVs. And there were actually a few groups that ended up with NPVs greater than 3 billion. Any questions on the finite life case? Now let me move to the longer life case. The longer life case, I've got to make the choice up front that I'm going to run this project for the long term. What does that mean? Now I need to bring in capital maintenance because I have to keep my assets kind of running as operating assets. So in the first case, I'm just letting them run down because I'm going to stop after 15 years. So in this case, I have to bring in capital maintenance. And in fact, this was the question I was asked most by groups working on the project. Why aren't you giving us assumptions about capital maintenance? 2 reasons. One is there is no one set of assumptions that's going to cut across the case. The second is in real life, this is the one assumption that you will not be given. You have to make reasonable assumptions. And the question is, what's reasonable? I mean, think of depreciation as calories burnt off. Think of what you eat as calories taken in. If I asked you, how much would you need to eat to maintain your weight? You're going to take how many calories you burnt off and try to eat about as much food that you get enough calories in. Depreciation is like burning off calories, right? You took your asset, and the extent that you trust accountants, those assets have been depleted. And if capital maintenance is what you need to do to make them whole again, the depreciation is the obvious number to latch on to and say, how much of that depreciation do I have to put back to keep this project going? Doesn't have to be 100%, at least early on, because your assets are still new. But that becomes the basis for your capital maintenance assumptions. Yes. No, that's not true, right? If capital maintenance is higher than depreciation by inflation, what are you assuming? Existing stores, existing equipment, whatever the capital expenditures are, get replaced. But because of inflation, what cost you $1 million in year 1 is going to cost you 1.1 million. So you're not making the stores bigger. You're not opening new stores. You're just reflecting the fact that keeping those stores looking new is going to cost you more and more over time. Yeah. Well, because you're not taking a CapEx. So basically, unless you have land, if it's building equipment, it takes a surprising amount of money to maintain what you built on the land. So if you're saying it should be a longer period of depreciation, you can change that, right? You can make it 25 years, but you'd still have the same issue of capital expenditure. So the same rule would apply. You now have a smaller depreciation to make up because you've built a bigger life and a bigger book value at the end. But the basic idea that you got to put back into a project to keep it going is a fundamental one, not just in investments, but in valuation. So here's what I did. I took my depreciation each year. I set CapEx at a number that reflected inflation. So in year 2, that's going to be a 1.5% inflation. Year 3, that inflation is going to build up. So as you go through time, what you will notice in my capital maintenance is it becomes higher and higher relative to depreciation because it's later in the period. So here's what my numbers look like. And if you want, you can compare this to my finite life case. What you will notice now is, in addition to everything you saw in the finite life case, first, you now have a capital maintenance number. And as I said, that capital maintenance is depreciation adjusted for inflation. The second difference is, if I'm going to run the project forever, there is no salvage value. I can't liquidate working capital at the end of 15 years. So working capital keeps going. There's no book value to liquidate, but I get one big price because I kept this project going, which is, at the end of 15 years, if I ask you, what's this project worth? You're going to give me this huge number relative to every other number, saying, that's what I think these furniture stores are going to be collectively worth as a business. I've replaced salvage value with the terminal value. I brought in capital maintenance. Everything else about the project looks the same. But here's what that terminal value calculation is. Basically, I assumed a perpetual life. And as I said, I didn't have to. And if I don't think any of the groups did this, but if you'd said, look, after year 15, it's unrealistic to assume that people keep buying furniture from stores forever. I'm going to add another 15 years and just make that my terminal value. Completely okay. I just said longer life, not perpetual life. So I've assumed a perpetual life. And with that perpetual life assumption, here's what my numbers look like. First, if you decide to do terminal value, and this is a purely mechanical detail, but kind of follow it because it could potentially get you into trouble if you don't, is I first computed cash flows in year 16. As opposed to what? Taking the year 15 numbers, putting a 1.5% growth and coming. The problem with doing that is, because I'm now treating the project as in steady state, I might want to change some of my assumptions about working capital and capital expenditures. So my year 16 cash flows were $929 million. So basically, you can go back and look at the previous page. My terminal value is at $929 million divided by the cost of capital, and this is all collectively global furniture cash flows, giving me a terminal value of $12,599 million. I did assume, though, that my growth in perpetuity would just be my inflation rate. Because if I could I have used a slightly higher growth rate? Yes. But if I do that, what am I assuming that Lowe's will have to do beyond year 15? To grow it higher than the inflation rate, you'd have to open new stores. If you open new stores, I'm now opening a door for fresh CapEx that I really don't want to deal with. So I've kept the growth rate at the inflation rate. Again, if you could have assumed a growth rate of 0% after year 15. There's complete freedom you get. Nothing is locked in here. And that's why I just left it as longer life. Because if you said, I think that my business will peak in year 15 and then drop by 5% a year, you could put minus 5% a year in perpetuity, which means your stores will start to close. Your cash flows will reflect a declining business. Complete freedom. You're never locked in when you do terminal value into a perpetuity and using a growth rate that everybody else uses. Now, just to show you what this trade-off looks like, because it is a trade-off of whether I want to run a project as a finite life project versus a perpetual life project. I compared my cash flows in my finite life case right there with my perpetual life case. Notice what I'm doing when I want to run the project as a longer life project. I'm trading off much lower cash flows for the first 15 years for a much bigger value at the end of the 15th year. In this case, that trade-off worked in my favor because my net present value went up. It went up because my cash flows went up by more. The terminal value kind of offset the effects. Is that always going to be true, though? That if you take a finite life project and push its life out, that your net present value will always go up? Common sense says it shouldn't be, right? Because otherwise everybody will be running their projects as perpetual projects. In this case, it worked out that extending the life of the project made it a better project. But in 80% of projects, trying to extend its life out will just kill the project, make it even worse. And that's why I have to bring in the trade-off. What do I have to give up to get that big terminal value? In this case, what you're giving up is more than offset. But you can already see that if you're a manager with a 3-year stint at this company, and you're being judged on earnings and cash flows that you deliver during your stint, you know what you're going to do? You're going to say, forget about the forever. I'm going to run this project into the ground. Because while I'm here, I'm being judged on earnings and cash flows, and I'll get much more in cash flows if I just run the. So this is the essence of the short-term versus the long-term argument. Value is long-term. So when people say when you focus on value, you're being short-term, they're missing the essence of value. What causes people to be short-term has nothing to do with value maximization. It's got everything to do with incentive systems and how you get rewarded and punished. So here's what your findings look like on the longer life case. Much bigger distribution. In fact, nobody had a negative NPV. Though there was one group which got a net present value 1 million in the perpetual life case. And there were a few groups that got net present values of more than 10 billion. One got a net present value of 250 billion, which I think has to be a zero mistake somewhere, zero added on where it shouldn't. But this is the bulk of the NPVs. And remember that change in net present value that I showed you that I got, which was about 1 billion. I also computed the change in NPV that you got as a group by comparing your finite life. And the bottom line is you get much bigger changes, either because you had capital maintenance in both cases, right? In which case you're really punishing the finite life case, or you didn't have any capital maintenance in your perpetual life guide. So unless you differentiate the capital maintenance between the two cases, your perpetual life is always going to look greater than your finite life case. So here's something to keep in mind. It should say after year 15. What you assume after year 15 will make a big difference in what kind of capital maintenance you put into this project. If you think the project is going to end and you say, I have no capital maintenance or very low capital maintenance, completely okay. If you think the project is going to have an infinite life and you give it a growth rate of 0% in nominal terms, you can set CapEx equal to depreciation, right? Because basically you're saying, I don't even have to make my inflation. If you set your growth rate equal to inflation, your capital maintenance should be higher than your depreciation to reflect inflation. But if you put in a growth rate greater than inflation, then you have an obligation to actually invest enough money. This actually is something you will revisit if you decide to go into valuation, the terminal value calculation for a company. One of the dumbest games analysts play is they'll play with the growth rate in the terminal value calculation. And in their calculations, when you change the growth rate, value always goes up. And what I'm trying to bring in is the offsetting effect that sometimes will mean that when you increase the growth rate, your value will actually go down. So let's look at what you found. As I said, there were 35 groups, but only 29 made it because the last 6 came in the last 20 minutes before I came into class. Of the 29 groups, only 1 suggested rejection. If you're the group that rejected, don't freak out. I'm sure you had a good reason for doing it, but 28 of you. Now, we make a big deal about living in a world where we trust crowd wisdom, right? We live in a world where we trust crowd wisdom. We pick restaurants based on Yelp reviews, what to watch based on Rotten Tomatoes. You know what, if you brought crowd wisdom to play, none of our analyses should be special, right? The crowd analysis should actually be better than any individual analysis. So I took a crowd computation by looking at what you found on average and as a median. On average, your cost of capital is about 8.4%, return on capital of 27%, finite life NPV of about 2.6 billion, longer life NPV of 6.6 billion, a change of 4 billion. If you want the median, if you prefer that. So if you were making projects based on crowd judgment, clearly the crowd here thinks we should go for the project, that it's a good project. And I've kind of come to the same conclusion with my analysis, right? But this is something that every business now confronts. This is in 1980 or 1990, where he said things are not going to change. We're a nice, mature business. There's a threat of disruption in the air in pretty much every business, right? You say, what are you talking about? Up till now, selling furniture online has been a tricky business. Why? Because people like to come and look at furniture, sit in furniture. So brick and mortar furniture stores have survived. But that could change, right? I mean, remember the mattress business until 20 years ago? Nobody bought a mattress that they didn't go check out and sit. Why? Because if you bought a mattress online and you did not like it, you're saying, what the hell am I going to do with this? So what did Casper do to disrupt the mattress business? If any of you got a Casper mattress? You buy a Casper mattress, I think you have like a month. How many months do you have to return it? I'd hate to think what they do with the mattresses you return and whether I'm buying your mattress, but they give you 30 days. You don't like it, no questions asked. You send it back. And you might, I don't like Casper's business model. But let's face it, they've disrupted the mattress business. That could happen to the furniture business, right? So I have a question. Where in this analysis have we brought in the threat of disruption, if at all? Give me some suggestions on where I could bring it in. Could I bring it into the discount rate? It's going to be very difficult to do, right? Because disruption is not something that easily gets captured in a discount rate. I could try in the cash flows. You know how I could try? Is I could try to make it my cash flows lower as I go through time. But it's going to be really difficult to bring into a traditional analysis. Now I can wave my hands afterwards and be careful, but how does that help you? You could do payback. Now do you see why people like payback? Because you say, let me at least get my money back before I get disrupted, because that way I can scrape through. Bringing disruption into traditional analysis has always been difficult. So you know what? We need to draw on probability and statistics. We're acting as, the problem we're having is we have this one expected value case, and we're trying to capture everything in there. And we now have a scenario where things could be vastly different. So in statistics, when you have things that can be vastly different, what's the most sensible thing to do? Create another scenario, a disruption scenario. Things are going to look terrible there. Guess what kind of net present value you're going to get? A big negative net present value. Disruption hits in year 3 and you've spent $2 billion already. And you can come up with the, you're saying, what am I going to do with these student PVs? How do you close this cycle? You got 2 scenarios now. A big positive net present value in your nothing happened scenario, and a negative net present value in the terrible things happen scenario. Attached probability is take an expected value. We don't use traditional probability and statistical techniques enough in finance. And I think we need to incorporate them, because especially when you have this kind of discrete risk, big risk that can change the economics of a business. Any questions on? So if you get a chance, go through the Excel spreadsheet. I'm sure there are a few mistakes I've still left in there, because when you're working with this many numbers, it's a given.
Professor, I had a question.
Go ahead.
So you used 1.53 as the levered beta for Lowe's.
1.6, 1.53, the regression beta, yeah.
Yeah, but like in point number 12 on the case prompt, it says that the adjusted beta 1.35 represents the risk, operational and financial risk of the business accurately. So why do you use the 1.53?
I should have used the 1.35 then. I probably have dyslexia, and 1.53, 1.35, that's a good enough excuse to give. But you're right, I overrode my own recommendation. So that'll make the cost of capital even lower for the synergy part of the business. Yeah. Right. Absolutely. That was my mistake.
Okay, cool. Thanks.
Any other questions on the case? So I want to kind of continue with where we left off. We were talking about project analysis, and go ahead. No, not for the company itself. That was for the furniture stores. He was talking about the fact that for the company, I said, just use the regression beta as the right beta and to use the adjusted beta. So I think that gives you 1.35, not 1.53. He's absolutely right. Yeah. So I'll fix that actually and put out the new version of the Excel spreadsheet. It'll raise the NPV of the costs actually because it's a net cost and lower the overall net present value in both scenarios, but not by enough to make a big difference. So let's talk about where we were past this page. We were talking about bringing in side costs and side benefits. I think this was where we were. Oh, right here. As I said, when you think about a project and it's the first project you're doing as a company, life is simple, right? Everything is in this project. There's cash flows. You do the NPV and you're saying, I'm done. But you think about a company like Disney starting a project. Think of Disney streaming, right? 4 years ago, they decided they're going to make a big investment in streaming. And they put in the money into the streaming business. But think of how they populated that division. They didn't go out and hire new people. They hired a few new people, but they drew people from their existing businesses. Why go out and hire people if you got some of the brightest people in animation and movies already there? They didn't open a new headquarters building. They took their Burbank headquarters and they had a segment of it that was underutilized and they used it for this project. You see where I'm going with this? Basically, Disney streaming draws on resources that Disney already has. That's a side cost. Are there any side benefits to Disney from opening Disney streaming that might not show up in Disney streaming per se? The last time I was, I took my grandson to Disneyland. He wanted to see whether there are any characters from The Mandalorian. He's a 4-year-old with a very advanced taste in movies. His dad lets him watch all kinds of crap on Disney Plus. So you can see the potential side benefit is if you have a Disney streaming show that takes off, you could actually make more money from, the Baby Yoda was actually a huge merchandising hit, 2 years ago? So what I'm trying to say is in general, you have side costs and side benefits. And all too often people wave their hands about it. They don't really bring them into the numbers. So I'm going to talk a little bit about how you would bring them into your cash flows and returns, because that's our end game. So let's take the first kind of side cost. It's called an opportunity cost generically, but it basically reflects the fact that when you use resources that already belong to a company, while those resources might not have a use right now, they could potentially still create a cost for the company. You saw this in the project in the distribution system, right? Right now, if I said, what's the cost of using excess capacity? Your answer is there's none. We're not using it. Just go ahead and use it. But there is this cost that shows up over time, right? Because you got to build sooner rather than later. So an opportunity cost reflects the fact that whenever you use a resource, you got to ask a question of what are we losing by using this resource? Let's start with the easiest scenario. Let's say you have a resource you have no use for. It's sitting around there. And if you did not take this project, you are planning to sell it. But if you do take the project, you're going to use it. There, the opportunity cost is by taking this project, I'm going to give up what I could have made by selling this asset. It's also possible that you might rent or lease the asset. Maybe you have, a building in Burbank as Disney that you're not using, that if you take this project, you're going to fill. But if you don't, you really have no use for it. You might rent it out. In which case, what do you lose? The rental income you'd have made from that property by leasing it out. Or maybe this resource doesn't have a use now, but it might have a use in the future. And by preempting it and using it for this project, when that need comes about, you now have to go out and invest in something new. So when we talk about opportunity cost, that's really what we're thinking about. So let's take a very simple example. Let's assume that we go back to the Disney theme park. We did the whole analysis. At the very end, I say, oh my God, I forgot to tell you something. This land on which we're going to build some of the Disney stuff that run the theme park, now we already own that land. And that land has a book value of 5 million. We bought it a while back. I don't know why. It's sitting in there. So the book value is 5 million. If we take this project, we're going to use this land. So there's really not, it gets utilized. But if we don't take this project, our plans are to sell the land. And right now, the market value of that land is well above book value. It's 40 million. I'm going to throw in an additional detail. You can decide why I threw this in. You have a capital gains tax rate of 20%. If I'm looking at the Rio Disney theme park, what is the opportunity cost of using this land I already own that if I don't take this park, I'm going to sell for? First, should I use the book value? Why not? Because who cares what the book value is, right? It means absolutely nothing. Well, the obvious answer seems to be we should take the 40 million we're losing, right? But think this through. If I do sell the land for 40 million, am I done? The tax guy comes after me. And when the tax guy comes, he looks at my capital gain. Now, do you see why you need the book value somewhere in this equation? Because you're taxed on capital gains, which is 40 minus 5, which is 35 million. 20% of that is 7 million. That's a cash outflow. 40 million minus 7 million, 33 million will now show up as the opportunity cost of this land. You can put it as part of your initial investment in the Disney theme park. So you don't have to keep it separately, you got to bring it in. But whenever you have opportunity costs, think through the entire set of consequences. Let's take a second example. So everybody comfortable with that example? Let's go back to Bookscape. Remember their online, book, they're a regular bookstore. Let's assume they want to start an online venture. Why? Because they're losing sales to Amazon. People want to buy stuff from their home. So here's what I tell you. I tell you that if you decide as Bookscape to create this online business, it's going to cost you $1 million upfront in capital expenditures, the kind of installations you need, computers, broadband, whatever you need to invest in, $1 million. Those investments are expected to have a life of 4 years, at which point they will have no salvage value, so you can depreciate them straight line. So you can invest $1 million upfront, $250,000 each year. The first 2 years, your revenues are going to be $1.5 million, and they'll grow. I'm sorry, in year one, it's going to be $1.5 million, growing 20% in year two, 10% in the 2 years after. So it's a 4-year project. You've invested $1 million upfront. I've given you the expected revenues. The cost to the books themselves will be 60% of your revenues. So basically, you got to net that out to get to your gross profits. You do have to, if you you need employees to run this. Those employees, the costs, that's expected to be 150,000 in year one and grow 10% a year for the following 3 years. So that's not included in the cost of books. This is an additional expense. Working capital, because you now have to maintain more working capital for those, will be 10% of revenues with the investments made at the beginning of each year. Again, remember, beginning and basically means the timing of the working capital. Tax rate on the income is 40%. So let's play through the numbers. Before I play through the numbers, though, I've got to decide what discount rate to use to discount those cash flows. You see, but we already computed the cost of capital for Bookscape. We did for their traditional book retailing business. At least when I did this analysis. Yeah, go ahead.
Can you update the slide for the people participating virtually? I think we're still on the project. Thank you. Thanks.
So here's how I'm going to come up with the cost of cap for the project. We remember we made the decision to use total betas for Bookscape because the owner is not diversified. I'm going to take the total beta for being in the online book retail business instead of regular book retailing. So let's say that's much higher, 3.02. Use the rest of the assumptions stay the same. I'm going to assume that debt to equity ratio looks like the industry. The risk premium is the US risk premium. And what I get as my cost of capital is 18.12%. I don't know whether you remember, but my cost of cap for Bookscape's traditional business was, I think, 12.2% or 12.3%. I'm getting a much higher cost of capital because this is a much riskier business. I'm holding it to a higher standard. So as with everything else, I'm looking at the project's discount rate. So this should now become a theme. Anytime you look at a project, you should at least try Sometimes you might get lucky and be able to use the company's cost of capital, but try to estimate the cost. Here's what my cash flows look like on this project. At time zero, which is right now, I have an initial investment of 1.15 million. Why 1.15 million? Because I got to invest $1 million in that infrastructure and 150,000 in working capital, because working capital is the start of each year. After that, I have my revenues, expenses. So basically the calculation looks very similar. I come up with the after-tax operating income, add back depreciation, and change in working capital. Again, that's a theme that should by now come through. It's only the change that affects it. So years 1, 2, and 3. And at the end of year 4, remember the project ends. And when the project ends, I get all of the working capital back. That's what the minus under the working capital gives you. So there are my cash flows. I discount them back at the 18% plus. The net present value that I get for this investment is 76,375. So again, nothing new here. I'm doing everything I did before, but a couple of interesting twists, which is this is an add-on business. I'm factoring in the effect of the add-on business. I'm looking at the incremental cash flows and discounting back at a discount rate that reflects the risk of those cash flows. But there are two side costs I forgot to give you. The first is, new employees are hired, right? But in addition to that, I'm going to take if you look at the online, the existing manager of the store, I'm going to ask that manager to take on extra responsibilities. Now that manager might be a sucker and say, okay, I'll do it for no additional salary. But if that manager says, look, this means I have to work an extra 15 hours every week, you're probably going to have to pay that person more. So I'm going to assume that if you take this project, you will have to pay that person $20,000 more next year, and that'll grow at 5% a year because you'd have expected to raise your salary. It's an incremental effect of this. The other is if the project ends, I don't know how you're going to pull this off. You're going to tell this guy, look, you're going to go back to the old salary. It's going to be tough to pull off. You got to figure out whether that's going to be permanent. But in this case, to keep my life simple, I'm going to assume it reverts at the end of the 4th year. So my cash flow effect is only 4 years. And this will use one of those old rooms in your in the facility that used to store records. You're going to use it as your office for your online business. But that room now is filled with these records from the past, which you now have to move elsewhere. And that's going to cost you about $1,000 a year to rent some other space to move those records to. So here's what it looks like. If I take the additional salary costs, so over time, the present value of those salary costs are $34,352. So think of that as the additional present value that I'm going to get in terms of cost. If you take the office cost, the present value of those office costs in after-tax terms, because even though I'm spending $1,000 because it's tax deductible, I'm effectively spending only $600. That's 1.6 million. So if you look at the NPV for this project with the opportunity cost built in, remember we got the NPV of 76,352, ignoring these, I now subtract out the 34,000 plus that I now have present value of additional paid to the general manager, minus the present value of storing those places somewhere else, I have a lower NPV. Here I've done it in two separate pieces, right? I did the NPV for the project and did the NPV for the side effects. I could have done them all in the same cash flows if I used the same discount rate. The advantage of doing things separately is you get the advantage of using different discount rates. If you do them all in one set of cash flows and you're using the same discount rate, the NPV I would get would be exactly identical. The reason I did things separately in the case was not because I wanted to torture myself by having 3 sets of numbers, but because I wanted to preserve the freedom to be able to use different discount rates for different cash flows. Now let's talk about a third case of an opportunity cost. And this is something that is very close to what we did in the case, right? You had excess capacity. I'll tell you what usually happens in companies when you have excess capacity. Excess computer capacity, excess distribution capacity, excess office capacity. In every company, if you've ever worked with a company, when somebody has a new project in mind, there's somebody who pushes for that project, right? There's somebody who's advocating for that project. They tell you how great the project is. And initially, if you ask them to come up with the numbers, the way they treat excess capacity is it's costless for you. I'm just going to use something you're not using anyway. So why even put a cost to it? So when you look at excess capacity, often the argument is don't attach a cost. You're not going to use it anyway. The answer to this question is pretty obvious. Why shouldn't you fall for that pitch? Or when is it okay to fall for that pitch of putting no cost to excess capacity? What has to be true about the excess capacity? If it will never have a use, not just now, but forever, and you can't sell it, you can't lease it, you can't rent it, then excess capacity is free. But in every other scenario, you've got to think through the consequences. In the case, that's why we put in the investment in year 5, because that is because of this project. We put the savings in year 12 because that's because of this project. So when you have excess capacity and it's getting used, you have to at least try to put that number. And the framework for thinking through how to price excess capacity is again a very simple one. So here's what and you all did this at least for the first half set of questions. First question I ask is, if I do this, when will I run out of capacity? The case that was year 6, year 5. There's a second question though, and this is the part that some of you might not have asked. If I don't do this, when will I run out of capacity? Why? Because the incremental effect is the difference in answers between 1 and 2. In the case, this answer to the second question is in year 12. Then there's a third question, which I preempted in the case. But when you do run out of capacity, do you have to build new capacity? Is there a law that says when you run out of capacity, no, you have another choice, right? What's the other choice when you run out of capacity? Bring down your sales. Say, I'm going to give up on sales. And if you had the choice, you'd give up on sales of your less profitable products. So we have 2 different products. The reason I kind of cut you off because then you'd have had to look at the comparable margins in building supplies versus furniture and decide which one am I going to cut off on. But that is a real choice that many companies face. Excess capacity is never free. Using somebody who already works for the company on a project is never free. You have to bring in those costs into the process. There's one final side cost benefit that's actually very difficult to deal with. Say in this case, let's assume you take the Rio Disney theme park, right? I made an assumption about revenues based on how many people will come to the theme park. If I hadn't built this theme park though, would those people have never gone to a Disney theme park? Or put differently, if I don't have a Rio Disney theme park and there are Brazilians who want to go to a Disney theme park, are they doing it right now? Absolutely. Go to Disneyland, you probably see a third of the people in front of you are from Latin America, because flying from Rio to Orlando is not that different from flying, within the US. You see where I'm going? What if I told you that 20% of the people who will come to the Rio Disney theme park would have come to a Disney theme park anyway? So what they're doing is, because it's more convenient to go to Rio, they're choosing to go to Rio instead of Orlando or Anaheim. You're saying, so what? If I truly take a purest incremental view of cash flows, then what would I need to do to my Disney theme park numbers? I should count only the 80% that is incremental, right? What's it going to do? It's going to lower my cash flows, potentially mean that I'm going to reject the project. So it's a big deal. So here's my question. Should I do that? If I am Disney, if I were told that 20% would have come to Disney theme park, why not? That's exactly why I shouldn't be including it, right? If I'm going to get it regardless of whether I build a theme park or not, why am I counting it as cash flows for this theme park and accepting this theme park? Because it's not, it's a what'll happen if I do it, what'll happen if I don't do it answer, right? You're telling me it's going to be exactly the same. So shouldn't I be ignoring it? Yeah. Go ahead. You had a hand up? You shouldn't. If you decide to bring it in, and reject this project. Let's say by bringing it in, you lower the revenues and expense, you reject the part. What's your biggest worry as a company when you reject a project because it's cannibalizing one of your existing products? What do you usually worry about? Companies face this all the time, right? When you have pharmaceutical companies come up with a new ulcer drug, your old ulcer drug is dominant in the business. That's exactly what you worry about. So now let's make this about Disney. If I reject this project, are those 20% people going to say, I'll go to a different theme park? Can you imagine telling your 4-year-old, I told you we're going to go to a Disney theme park, but there's a new theme park right down the road. Doesn't have the same name. It doesn't have Mickey. Try pulling that off with your kid. You see where I'm going? Disney theme parks have such a strong competitive advantage that I think you should take out. If you have sales, you're going to get anyway. So if this were the case with this theme park, I would say look at only the 80%. And if you reject this theme park, the worries you normally have don't exist here because those people are still going to go to Disneyland or Disney World. But it's very project specific. If I asked you, should Disney produce a new morning show that's going to eat away into the revenues of another morning show on Disney cable? I'd say, don't factor in the canon, because if you don't do it and somebody else does it, there the protection you have against competition is much milder. Remember, I gave you the example of pharmaceutical companies. You know what pharmaceutical companies that dominate a particular, so let's say you have the dominant ulcer drug and you have 15 years left in your patent. You've come up with a new ulcer drug that's better. You might choose to delay it because you own the business. This is a business. We have patents, you have protection. But if you're in a competitive business, you're going to ignore that. Yesterday, I was walking with my daughter down, we walked from the village all the way up to 47, and I counted the number of Starbucks I passed on 6th Avenue. There's almost a Starbucks on every other block. So can you imagine the project analysis that Starbucks has to do on a new store? You open one on 47th Street, and you already have one on 45th Street. Where are half the people coming from? From they'd have been the ones they live on 44th. Right now it's on 45th, or they live on 48th, and they're coming down to 45th. Now you have something a block closer. I've always wondered whether Starbucks factors in only incrementals, because if they did, they wouldn't be opening these stores. One reason I think Starbucks is in trouble is each store, I think, is being analyzed almost as a standalone store. That's extraordinarily dangerous because you're going to have too many stores. And it's not unique to Starbucks. You look at retailers, you look at manufacturers who don't produce a product because they're afraid of cannibalization. You got to think through what the consequences are. So I'm going to leave one final question.
Yeah. So we're looking at it as revenue level, but should we be looking at cash flow revenue?
Yeah. So basically, you trace out all the effects, because remember, everything in that theme park was connected to revenues. So when I remove the revenues, I'm also going to remove the 60% of revenues that are the direct expenses. So because all my costs, if you look at the Disney theme park analysis, were tied to revenue. So when I lower it, it's not just the revenues. My expenses will be lower. Even my allocated G&A, because it's based on revenues, will be lower. So it's ultimately the cash flow effect, but the cash flows are always going to be lower if I take 20% of my revenues off. So it is the cash flow effect ultimately that's driving the choice. Okay, see you on, I forgot to mention, Monday is your next quiz. I know there's no rest for the wicked. You just finished your case. I'm really sorry to do this to you, but I will be saying, no, there should be an email automated to get to you in about 10 minutes about the quiz and what it covers, and a review session to watch. So, and I will add an additional office, set of office hours this weekend just for questions about the quiz. I will talk to you later.
Yeah.